This meeting is being recorded.
So, welcome everyone. I gather that this is being recorded according to that robotic voice that just came up. So it's this is an Institute of Directors webinar on exiting your business and what your options are when selling. So I thought we would kick off with just some introductions. So Mike from Turcan, Connell, if I could ask you to just introduce yourself to start with, please.
Yeah, thank you. So I'm Mike Kane. I lead the corporate practice at Scottish and UK firm Turcan Connell. So we're largely a private client firm looking after entrepreneurs and family businesses, and my role is largely helping that group of people to exit their business. And as a result, we see some really great transactions, work with some really good people across the process. People like Neal and Phil, with whom I've had the pleasure of working.
Neal Allen, I'm a director at H&H. We're a corporate finance boutique advisory firm, so we essentially just advise people on principally selling businesses, but also buying businesses and raising finance. I'm a shareholder in the business as well, so I probably have been on the journey of pain and the ups and downs of being an equity holder that some of you will have experienced yourselves. But principally, we focus on giving best quality advice to businesses. We tend to be ex-Big Four. We're director-led, and we really aim to help people navigate through the sometimes choppy world of selling a business. Phil.
Thanks, Neil. So I'm Phil Morris. I'm, I guess, an entrepreneur. I always struggle to describe myself as that, but yeah, I started life as a chartered accountant, and then I ended up building a business called Cookery Sports, which I exited to JD back in 2015, and since then I've been involved in a lot of businesses here in Scotland where I now live. And Mike tries to keep me out of trouble, and I think Neil might try and get me in some trouble. So between the pair of us, we probably know a little bit about buying and selling businesses. So Neil, if it's okay, if I could start with you, from your perspective, when as business people we are beginning to think about exiting or selling our businesses, what do you think the primary things that we should be thinking about as we ready ourselves for that sale? What would be your primary bits of advice to people, to get themselves ready to sell?
I suppose the good news is that pretty much everything in terms of readying a business for sale is exactly the same as good practice in the business generally. In terms of making sure that a business is presenting its best self to the world, if you like, through a process. It also needs to be those things. There's certainly, despite some of the myths about the sort of red meat, red braces, and red wine school of corporate finance advisory, the bottom line is people always get to the bottom. Most of the time in a transaction. So being fairly transparent but presenting things in the right way is key. So sitting under all of this is a good business. It's having the good business practice around strategy. Is the strategy clear? Is it obvious exactly where the business is going or could go under new ownership? Does the business have a strong form of governance? Is it owner managed, or is it the business decision making process split across numerous different people? Is it one? Is there a board of directors in place? Is there a quality of staff around either owner managers or just a quality board in the case of absent shareholders? And is the business investing in growth? The best thing in readying a business isn't necessarily to cut overheads, drive profits upwards, because people start to look through what is in the business and ultimately what is somebody buying and where could that business go in future. So they're looking at the investment, whether that's in people, whether that's in capital expenditure, whether that's in the procedures and systems behind the business. So lots of those sorts of things, which none of those would be anything that isn't seen as just generally good practice, but they're all good things that will underpin a business sale.
So Neil, if when you're running a business? Obviously, you're worried about the day to day. You're worried about making payroll. You're worried about the profit. You're worried about keeping customers happy. Do you think there's a real shift that's required to beginning to focus on, as you say, governance and, essentially a clear vision for the company? I mean, is that something you kind of have to find yourself advising people to do?
We certainly don't find that is the case, but I think what can ease that is the length of time in the preparation. Inevitably, I think if somebody just wakes up one day and wants to sell the business and then everything has to happen, that's where you can find issues. I think, as with anything, the longer that you spend thinking about that and getting all of these things in place, the less of a shift it is, and the more it is a gradual transition towards that. The questions we usually get asked through a sales process are fundamentally, who's going to take the business going forward, and how, and if the answer to that is, well, it was the guy who did own the business, is exiting stage left. That creates one sense of weakness, especially if they were also running the strategy. So it's about preparing. I think the key thing, that if the one piece of advice for us, is the best sales process are the ones that we spent a long time preparing. And I've got one client in the middle of Scotland at the moment who I think we've spent the best part of 6 years talking about an exit, and that's allowed us to get all of the starting blocks in place, particularly around management, but also around strategy, around how many factories the business needs, what the growth strategy looks like, which systems need to go in. And even after 6 years, we still haven't got everything lined up, but we've certainly got a plan in place for all of those areas.
And have you got a minimum sort of timeline that you feel is needed?
No, not really. I mean, because you can sell a business. Somebody wants to sell and none of these things have been done just due to a change in circumstances, which obviously does happen, then you can still do that. But optimally, I think they optimally need to be starting to think about a sales process at least a year in advance, especially given that even in the run-up to COVID, but certainly exacerbated post-COVID, is that all sales processes, and I'm sure, Mike, you'll probably sort of seen more of this than me, is that everything is taking a lot longer now. So we always used to pitch for work where we'd say upfront, sales process 3 to 6 months, and I think you're now talking 6 to 9 minimum, just to get through.
And when we're first considering selling, how would you recommend somebody coming up with some outline value as to what their business could or couldn't be worth? How do you best approach that?
Well, of course, Phil, you speak to an advisor who tells you, but more specifically, probably depend. Unfortunately, there is no one answer to valuation. It's certainly an art, not a science. But I think it probably ultimately depends on where the business is going and where it's going and why it's going. So if you speak to any advisor, slightly tongue in cheek, they ask somebody what a business is worth, and you always get 5 times profit as the answer, because and whilst that is a bit of a get out, which everybody always seems to default to, there's a bit of a reason behind that, is that because for a business that's performing reasonably well with reasonable growth prospects, 5 times earnings for a business that's probably got operating profits of around 10% will work out at a number that everybody can live with more often than not. So but that's not, that isn't an answer that anyone should be satisfied with. So how do you go about valuing the business? Partly depends on the factors of what state the business is in, what quality it is, but ultimately looking at what interest is in a particular sector, which drives the interest drives prices upwards.
Yep.
You're looking at the fairly fundamental basis for most valuations of an EBITDA multiple, because that's what most of the industry is working to. And actually, private equity have to value their businesses on an EBITDA multiple basis, through the venture capital institution.
Just remind people what EBITDA is.
Earnings before interest, tax, depreciation, and amortization. So essentially, operating profit of the business, give or take a bit of capex, and depending on where the business is. So then, if you then take that to say, what's driving those multiples, if you like, because ultimately multiples are only a bit of a construct in order to compare prices for different businesses. Well, the multiple is driven by the interest in the sector. So trade parties and financial parties are really the only two groups of buyers you can go to. If you've got people who buy and sell businesses for a living, financial parties, or you've got trade parties in the same sector or a similar sector who are looking to buy the business for what it can do for them in terms of their own strategy. So the hotter the sector, the higher the multiples. And we sold a business in the bioscience sector earlier this year, where the multiple was 12 times EBITDA. Yeah. And equally, we're working with a building products business at the minute, which at the moment is a bit more prosaic. Everybody wants the science and the technical elements. And that's a sort of a 4 times multiple. So that could, and sort of just a comment that's cool about employee buyouts, which that is an option as well. So we can probably cover that off later. But that's what it. So it technically forms under the sort of financial buyers, and there's a financial element to that.
And do you see a difference in multiples on EBITDA? If your EBITDA is sort of below $1 million, are you seeing a lower multiple versus if you're above $1 million? Is scale a factor in terms of valuation in your view?
I mean, it certainly can be. I mean, in answer to the direct question, there is no minimum turnover or profit level considered for a sale. So there will always be potential buyers, but unfortunately, it is a bit of a fact of life that the larger the business, frequently the more interest there is. I think it's also the larger the business and the larger the opportunity, the more interest there is as well, because in a lot of the sectors get hot because everybody sees the opportunity to build a business in a particular sector and then sell it as well, which often from a financial perspective is the end goal, is to actually sell it, is to find a way out of the business, not just a way in. So the chance for opportunity to grow, build businesses, can be as strong as a ready formed, fully finished business. So all of these factors, sector growth, ability to grow, potential industry, and potential to really drive something new, all drive value. And typically, you're using a multiple of profit to indicate a comparative against other businesses. And for businesses that are earlier stage, higher growth, perhaps don't have profits, then the multiple just switches to turnover.
Okay. And there was a distinction, I remember dealing with Mike about the distinction between enterprise value and equity value. Can you let that or remind me what that was? Because it's
and certainly that is a particular, I'd say that is a particular dark art in this. I mean, valuation is an art, not a science, and certainly the difference between equity value and enterprise value is. So when we're talking about a multiple of, if the business is making 2 million of profit and the multiples is 5 and the business is worth 10 million, that's your enterprise value. If the business has a sum of cash on the balance sheet, which is surplus to requirements, very simplistically, then if that cash was 5 million, then the equity value is your 10 million of enterprise value plus the cash, which is deemed surplus to requirements, which obviously is for the ownership, which is the equity value. So that's in its simplest form. Where this becomes a real tug of war, and I don't think I've seen many, if any, deals where this hasn't been the case, I'm sure Mike will be exactly the same, is there are numerous constituent elements between equity value and enterprise value, and they're usually negative, which becomes can be a real creator for value for the owner, and it's a way of substantiating a lower price for the buyer. So typically, the two main areas are either cash or debt in the business and working capital within the business. They're the main two areas that you can adjust the price of something. So it wouldn't be unusual for us to have the hypothetical client that is worth 10 million, where somebody comes in with an offer of 10 million, and then they decide that the business actually needs 2 or 3 million more investment through cash or working capital than they originally anticipated, in inverted commas, and mysteriously that equity value then becomes 7 as opposed to 10. So a lot of our time and any advisor's time is taken up in that review of what does the business look like from a day-to-day basis? How much working capital does it actually need through the course of a year, through the course of a forecast period, and how much cash or debt sits within the business on a permanent basis, if you like. And I think in that, I see a lot of deals where businesses have gone into that with a little bit with their eyes closed, and unfortunately have ended up thinking they were going to get an equity value of 10 million based off an enterprise value of 10 million, have been substantially lower than that. So it is I think it's one of the critical areas. It probably is one of those things that can't be under-advised. I mean, there's no right answer, but certainly if you've got the ability to analyse in depth working capital, debt, and by debt that could be HP, it could be corporation tax that's owed, it could be bank debt, it could be some sort of contingent liability. Having the ability to get into that and substantiate a number is absolutely critical in any sales situation, but particularly when selling to a financial buyer, because a financial buyer is always looking for a way to reduce the price.
Okay. And I think that comes back a little bit to your point at the beginning, doesn't it? Which is, I'm always amazed when I deal with some business owners. They're so busy doing what they do. This actual thought process around the sale is perhaps not given the consideration it should be. It's the old Stephen Covey quote, isn't it? Begin with the end in mind. And if you're trying to exit this with a particular goal or a particular value that you want to achieve, you have to give yourself some time to make that a reality. And a bigger consideration.
Yeah, and I think, I'd use a real life example of it. Quite a long time ago, I was involved with a caravan manufacturer when I was working in private equity, and the working capital swing in this particular business, which is about 100 million revenue business, so it was quite a large scale one, the cash swing was about 25 million from start to finish during the course of a year. So the ability to try and get this business sale at the right point, at the right cash balance, was a massive amount of value to the transaction. And as you say, the lot earlier you can get into that analysis of where does the working capital cycle go, where does the cash go, where does the debt go, the better it is. And actually, if you go back to the point around what is good for a sale is really good for a business, is looking at working capital in that sort of detail and optimizing it is good for the business, whether you sell a business or not, to be honest.
Yeah. Okay. So Neal, last question for you really is just in terms of when you're coming across a sales opportunity, how do you go about finding potential buyers? I know somebody's mentioned obviously employees as one option, but how as a company do H&H go about getting a group of potential buyers to take an opportunity to?
A lot of it is either through research or through networks. Ultimately, I mean, there's only so many places you can get buyers from. I think if you went through the thought process of it with any business, it comes back to what does the business look like? How ready is it for sale? Because if there is a clear sales story for the business, it does open up both trade and financial parties. If there's an active management team, if there are growth opportunities in the business, then, and actually when I say this isn't just about sales, it could also be about just taking on investment to grow. It's exactly the same set of principles, really. So that sort of drive, if the growth prospects there, then financial parties will always look at a business. So, and from a financial perspective, we know a lot, and any advisor will know a lot of the advisors, a lot of the potential financial parties in the marketplace, both people providing debt and people providing equity, people providing equity in particular sectors or for particular purposes. So that's, I suppose, it's a bit of proprietary knowledge, but there's always research that can back that up. And then in terms of trade parties, again, there'll always be knowledge of certain businesses, but a lot of it is research driven. Is where are you going out to? What are you looking for from a particular acquisition? And then ultimately, it is a lot of the advisor's role is identifying the right person to speak to. It's not just about finding the trade party that might be interested. It's about finding the right touch point and why, and actually also positioning the business, positioning the business that's for sale with that particular, with the potential acquirer, because it might be a different reason in each case. One business might literally just, in your personal opinion, might be looking to buy the business for what it is, but the second business might be looking to buy the business because of something it unlocks or a particular sector. So there is an element of trying to be a little bit bespoke towards each buyer, particularly the buyers most likely. I mean, we would always grade our potential interested parties, with a 1, 2, 3, 4, however many numbers you want, where we think the ones are the most likely. That might be 5 or 10 businesses. Two less likely. Still very likely, just not as hot as the ones, and so on and so forth. So we would approach them, and we would try, particularly early on, to be as bespoke as possible in positioning why you, the prospective buyer, wants to buy this particular business.
Okay, cool. Mike, just coming across to you. I know you're a lawyer, but the thing that made me laugh when we first sort of did a deal together was you're more of a psychologist than a lawyer, I think, at times. Talk us about how we have to get our mindset right for the sale and the whole process that you're going to go through. I mean, in your view, how should people be thinking as they start that journey?
Yeah, no, really, really true. So I think, as Neal was saying, Phil, we like to try to start the process quite early with clients. Sometimes that involves a few years in advance. So process of getting to know each other, I think that's really quite key between clients and the advisory team. So we can absolutely execute a transaction. So if somebody turns up and says, right, there's a set of terms, let's go, let's get it done. But actually getting to know your advisory team, because there can be some really dark moments in the process. So I usually start by saying to clients, it's a very complex process, which is kind of akin to a blend of chess and poker at the same time. A lot of it's about strategy, stamina, something that you're familiar with, and approach it like you're going to run a marathon, Phil, because the sales process itself, and I'll come on to talk about due diligence and things in a minute, but it's really quite invasive and intrusive. Having somebody crawl all over your business like a rash, leaking under the floorboards and in the attic, and for bits of paper that may or may not have been signed 25 years ago in connection with a share option scheme or something. So that is quite stressful, but equally your point earlier about trying to run the business at the same time. So you've got the practical issue of all the day-to-day stuff, but if you then start turning up at your photocopier for 2 or 3 hours a day when you haven't really been used to that, your employees are getting the drift that something is going on. So it's managing that, it's managing running the business and working out a plan for dealing with your advisory team. So your advisors need to prepare you for the process. Absolutely. And I think there's a question just before I started speaking about management team and how you might bring them along into the process, which is a great question. And the first thing is confidentiality. You might need, depending on the size of your business, to rely on management. So you might actually have to bring management team into the fold so that they know what's going on. But equally, and you and I had a deal together not that long ago where the management were not signed up to any restrictive covenants, which potentially destabilized the price. So actually we were not acting on the sell side on that one, but it potentially destabilized the price because management team could walk with clients in contact. So thinking through some of the detail around that and managing really key. The other thing, I don't know if we invented this phrase, but timing is everything, and it is actually everything. Why on earth would you wait until the point of retirement to market your business? So I think in Neal's world, he's the guy that's trying to get your best price for you. If you rock up, I'm retiring in 3 months' time, I've got a health issue, the economy's just crashed, that's not really a perfect time to offload your business. I mean, you're on the back foot price-wise immediately. So the best time to sell is actually don't have to sell. And then also thinking about who the investors are in your business and the types of businesses we're all working with. So privately owned, closely held, family entrepreneurial owned businesses. The key investor in those businesses, Phil, is the founder. And it's quite astonishing because you would not take a lump of exit proceeds and go and invest those in, a single stock on the stock market. So perhaps starting an exit journey earlier, so bringing management team in, maybe partially through an employee buyout or partial management buyout or business growth fund or something, and warming up for a full sale down the line in 5 years' time or something is a good way to go. So just thinking about your business as an investment and the risk that you carry with that. So not leaving it too late. Don't rock up.
Would you agree, Mike? This is a bit of an identity issue. I mean, often I find business owners want to be absolutely integral to the business, and they really struggle with the idea that they are potentially replaceable. And in fact, if they want any real value, they're going to have to be replaceable. Otherwise, they'll never get out of it. So it's this identity of, what have you created the business for, and what's the outcome that you're looking for? So that.
Well, I absolutely, and I think having a good sort of succession plan behind you, management team that you've been building up. So you want to be, when you're starting a business, I think you want to work towards making yourself redundant, so that you separate leadership of the business from ownership, and it's the leadership that you're passing on to somebody else and exiting from the ownership. So thinking about these two things as separate, identifiable strands, and of course it's the change in ownership that will realize funds.
So when you're beginning to think about the legal issues, what are the primary legal issues that people should be thinking about as they start their sort of sales journey? What kind of advice would you give as the primary things that they need to be thinking about?
Yeah. So being prepared, and again, it feeds into how you're interacting with a buyer, and essentially making the buyer think that your business is totally robust, and that all feeds into the due diligence process. So the first thing that we do when we meet a client, we've gone through the chat about how long it might take and how resilient you have to be, is we share with them the legal due diligence questionnaire, which sounds really techy, but that's a list of 20-30 pages of very excruciatingly detailed questions. What's coming, and it cover tax, environmental, employment, contracts, all that kind of stuff. But obviously, I mean, when you're selling a business, while you don't get rid of all the liabilities, when you're selling a company, actually what you're doing is sticking the liability for the business onto the buyer. So the process is about finding out from a buy side what liabilities might be stepping into. So if there's been a tax fraud, for example, a discrimination claim, a health and safety at work problem, somebody's gone under a bus, all that kind of stuff. So that is why a buyer will want to go through everything, not just from a financial point of view, but from a reputational point of view as well, so that they're not stepping into personal liability for something that's happened in the past. So that due diligence process has, by function, got to be really detailed. It will be across legal, accounting, tax, commercial, regulatory, all these issues.
Okay. I mean, I guess livening this up slightly, give us an example of a sale that's gone really well, and why did it go really well, and an example where it's not gone so well and why it didn't go so well. Because I think it's easier, isn't it, for people to feel real examples. You obviously don't need to use names or numbers, but just the principles.
Yeah, probably. So two or three examples. So probably timing issues. Firstly, so I mean, selling a company when you're on the sell side is an expensive process. By the time you speak to guys like us, tax advisors, accountants. So if you're 70 to 80% of the way through the process, you're in waist high into fees. And that can sometimes drive the outcome of the transaction. So often if all your funds are tied up in the company and your assets are illiquid, you've racked up all these fees, it's difficult then to stop the bus, to stop the process.
Yeah.
And a savvy buyer will know that. And what then happens, so back to the psychology of it, what then happens is price chipping. And that in our world is the biggest thing. So in fact, I was in a horrible position once where I'd taken a transaction. It was a £5 million purchase I was acting for some English purchasers. It'd been quite a tortuous negotiation. And on the last day, on the day of completion, the sellers, their lawyers, and the seller himself was in our boardroom. And the client phoned me and said, "Okay, Mike, it's time to get the deep fat fryer on and go in and look for the price chip." Okay, well, why is that? I need to understand what it is I'm going to be asking for. Well, it's 25% off. We found some stuff in the due diligence process, some revenue items, tax issues. So your job is not to know why. Your job is just to go and ask for 25% off. So rightly, the seller just walked out, and we never heard from him again. So from his point of view, I think his advisors had managed him quite well, which was know what the limits are and expect a price chip can happen. So I was put in that position by the client. I was a messenger to get the price chip. From a timing point of view, so Neal alluded earlier, Phil, that transactions are days. And what has obviously happened is interest rates have gone up. We don't know if we've reached the top with interest rates. So if you had a deal that was signed off for funding by the credit committee in summertime last year, that's a very different position to where we are now. So the arrangement fees, pricing, the affordability, the cash flows have all changed. And what we find is, as the interest rates affect through into transactions, banks have just calmed the jets on them. Private equity as well. So deals are just taking longer to get to completion while people get used to this new sort of financial landscape. But you asked for a good news story as well, and we had a transaction which we started in December 21, and there were 4 competitive bids for it, and the money was in the bank by February, and it was a very big 8-figure deal. Like Neal said, because the size of the business was good, it was scalable, the EBITDA was on the up, it had a good management team in place. All these factors contributed to that's a good business that we can just port from there into our portfolio. So that was in fact a great deal to execute on, and they do happen.
Okay, cool. Now, one question for Neal was business brokers. Neal, I know lots of businesses who will be receiving letters all the time from various business brokers. What's your advice in terms of those kind of approaches? There's lots of people out there kind of going, "I'll sell your business for you." What should people think about in terms of who advises them in this? This sort of one-off event often for people.
Yeah. No, it's a good question, Phil, and I suppose I don't say I have a slight bias because we would definitively say we're not brokers, but ultimately what I'd say is, well, first everyone has to make their own mind, but I would say that it's more than likely that certainly 85-90% of people are only going to sell a business once. So ultimately, whoever's selling your business, my view is you should want the best possible advice going through that process. And there's certainly nothing wrong with the business broker model. It's very marketing led. They have very good connectivity with lots of different email addresses for people or institutions. But what you don't get, the difference between a broker and an advisor, I would say, and I hope this isn't too harsh, is that the advisor is literally with you every step of the way, you know, in terms of creating the collateral, in terms of trying to be as bespoke and giving you bespoke advice as possible, not a generic advice because it's a volume game. Advisors who can take the time to work with you, what are your options, why are they your options, what are the implications of each of those options, and ultimately then even I think from the point where you have an initial bid for your, or you accept an offer for your business, you've still got more than half of the work to do. The negotiation of everything from we talked about the enterprise to equity value bridge, all of those working capital and cash items, all of the things that Mike talked about around the legal process, every step through warranties and disclosures. I mean, none of these things are easy, and then your final set of documents as well. That whole process it's time consuming. You want people who I suppose specialize in that and who spend the time to go through it. And I think that's the main difference. And obviously, and if you're a broker, you say, well, we reach the parts of the people who can't. We'll get out to the market. And obviously, as I say, there's horses for courses. But my view is to do something like as important as that. They would. That's the key is to get an advisor in place.
Okay, cool.
I would say,
oh, sorry, Mike.
as well, what I'd add to that is expectation management.
Mm-hmm.
So having worked with both groups of people, I think you can get drawn. It's a bit like selling your house. You might just appoint the estate agent that says what the largest expected price is, but actually, so again, that's how price chips feed into it. Actually, what you want is somebody who's going to give you proper advice. What's the right time to sell? What you're going to have to do to optimize the business? Perhaps come back in 3 months' time once you've done X, Y, Z. And price negotiations expected about price negotiations. So it's that very close advice as opposed to mail shots. Here's what you should expect to get, and you don't.
Yeah. No,
see that.
Okay. I think the one point I'd make really is just there is a distinction really between smaller businesses and medium-sized businesses, and that undoubtedly smaller businesses struggle to get themselves set up as well as perhaps a more medium-sized business could. And I think business brokers and a marketing-led approach in that regard, I think Tam's just put a note on saying, all they do is market them. They don't necessarily sell them. And I think that there's a fair bit of truth in that. My understanding of the stats are roughly only 20% of businesses that get listed in that kind of way actually sell. So, there's a debate here about scale and who your appropriate support is, depending on how big the business is. Can we just talk a little bit about employee buyouts? That came up as one of the questions. I mean, what's your views on, VIMBOs to employees or kind of employee owned businesses? I think, Mike, you've got lots of experience in both of these. What's your views on that as an approach?
Yeah, no, really great outcomes with those. So we have just focused largely in this discussion on a trade sale or private equity sale, but I think the point I'd make is when we meet a new client, get to know them and get to work out what their dynamics are, what the drivers are for exit. And more it's about legacy and looking after people. And an employee ownership trust, employee buyout does actually work really well in certain locations, rural locations where the employer might be quite a significant employer. I mean, not only, but that seems to be quite neat. Also, so they go hand in hand, Phil. So an employee buyout and a VIMBO, which I think you mentioned, which is a vendor initiated management buyout. Yep. And really the benefits of either of those approach to a seller is taking control of the process. So driving price, driving the warranty terms which are available, and actually not leaking confidential information into the marketplace. So you can dictate a number of different things through an employee buyout or a VIMBO in a way that's just not possible with a sale. And of course, employee buyouts, employee ownership trusts have a massive tax advantage just now, where there is no capital gains tax on sale into an employee ownership trust of more than 50% of the share capital. So it does certainly have its attractions.
Yeah,
they're not the easiest of transactions to do legally, but yeah, they are good.
I think they're I would say they're an alternative, but they're not always appropriate. I think for professional services, this is just my personal view based on experience. For professional firms like lawyers or accountants, for one of a better example, EOTs can work well as an alternative to partnerships because everybody participates in the profits of the business and slightly tax efficiently. For higher growth businesses, or perhaps more traditional structures of management team and then a hierarchy of whatever the hierarchy looks like, I think EOTs can be quite restrictive because as a management team in that business, you never actually own the shares. So, they always sit with the trust, and that has clearly drawbacks in terms of driving value for you personally, if that's your agenda, and driving the value for the management team. So they certainly have a place as a potential option, but they don't always work. And what they could do, I think this is still being tested properly in the market, is if you put all of the shares if you go down the EOT scheme, and the point that's just been that you can combine EMI and EOT, that is a very valid option. But I think where you go into the EOT, you are adding the complexities around a future sale. We've got a couple of these at the moment where because if you go down the EOT route, some of the things we've found, and just examples, is it seems to be harder to get investment into the business for whatever reason, and also there is then the future exit strategy. What does that look like? If you're a management team leading a buyout, you're leading it towards an exit. In a EOT, you're introducing a layer of the trustees who are looking after the trust, who have to agree to a sale. So you're adding in maybe less clarity around a sale, and actually there's less in it for the management team to sell in that instance.
Okay. One thing we've not really discussed is terms of selling. I mean, obviously, people are used to selling a house and getting the cash on the day of the transaction. I mean, what kind of structure do people need to be thinking in terms of when they sell their business? What are the likely outcomes going to be? I guess to both of you, both got lots of experience in this, but what should people be expecting in terms of a term payout for their business?
Yeah, well, I guess everybody wants cash fill on day one, and that's the least risky. But again, it comes back to a bit of a tax analysis, and there are different sort of pricing structures that we could go through. But I think starting with the discussion about tax is always quite helpful because it does feed into some of the other things. One of actually the issues of cashing in your business is that this will sound very technical, but you convert what is an inheritance tax relieved asset, business property relief, so the shares in the company into cash. If you die shortly after that, all of the cash comes into your estate for IHT planning. So just that needs more in mind, and that might actually feed into things like earnouts and loan notes as well. Mm-hmm. And we've had, you and I have worked on a deal where a seller chose not to pay the tax on the loan notes. I think the entrepreneur's relief was heavily restricted and changed to business asset disposal relief at 10%, and all of those loans immediately became taxable at 20% instead of 10%. So thinking about that as a structure, obviously quite key. I think with earnouts, what I do say to clients is you just have to see an earn out as a bonus because if you get it, all well and good, but you have to write it off in your head because ultimately you're passing control of your business over to somebody else, and it doesn't matter how tightly drawn the legal documents are. The buyer's got control. They can make staff redundant. They can ship in management charges, all sorts of things to reduce or eliminate the earn-out.
I think before, so I suppose just in terms of the questions, some earn-out is where somebody agrees to buy 8%, say, let's say 50% of the business up front, and then we'll buy the residual 50% based on future performance, or buys all of the business up front and will pay further sums based on future performance. So the key there is the future performance, as Mike said, and some of Mike's earlier comments around the control over a process. Now, the vendor needs the more in control a seller is, the better. Second, you've sold the control to somebody else, the harder it is to have pure profits, which then feed into your future earn-out mechanism. So in 2 years' time, has extra cost gone into the business? Have there been adjustments to something within the business outside of your control, which then have an impact on your earn-out? Which obviously part of that is in the documentation and the legal documentation of a sale and purchase agreement to make sure that doesn't happen. But obviously you introduce an element of risk. And I'd say pre-lockdown, I don't think we ever advised any clients to take an earn-out or a deferred element of consideration if we could absolutely help it. That was the last resort. I think just as a unfortunate current mechanism is almost every deal that we've advised on since lockdown has had some element of earn-out, unless it's been a strategic deal or something that's been a buyout, perhaps at less than the optimal price. Then almost every deal now has, because of the uncertainty in the market, because people don't want to make decisions, every deal seems to have an element of earn-out in it. If we were still taking the same position, we wouldn't be doing many deals.
Right. And what kind of percentage would be up front versus on an earn-out, in rough terms, Neal?
It could be any number, Phil, but I mean as a live example, I'm currently working on something where there's a 30%, 70% upfront, 30% deferred, and the offers on that business rate did some were 100% upfront, some then one was 70-30, and one of the other one was 60-40. So it could be 50-50. They're going to buy a majority of the business upfront, I would say, and they're going. So if you had to give a range, and it would be different each time, I'd probably say 50 to 75% would be upfront with the rest on earn-outs. But that would vary depending on what the deal.
I think I'd start getting quite twitchy if the earn-out was more than 20%.
Yeah.
Okay.
You'd maybe want to defer some of that. So cash, fixed amount deferred, so seller sticks around for a period of time, and less of an earn-out. But the higher the earn-out, the more chaos that can cause. I'd be worried about.
And an earn-out, technically, it can take the form of equity rolled into a new structure. Yeah. It can take the form of loan note, which again, some of the technicalities is, but putting a loan note in to help fund to meet a gap in the funding requirement for an acquisition is still a deferred element of consideration, whether it says it is or it isn't. It says that the loan note, it still is.
And you also need to think about security. If you've got loan notes, substantial levels of loan notes, what's the financial covenant of the person behind the loan note? Yeah. So just think that, and often there is nothing. You just have to take a flyer.
Okay. I'm conscious of time, and I'm just conscious that we've got some questions to make sure we've covered them. So there's a question around minimum turnover, which I think we covered. So, I think any business is sellable, but the bigger it is, the easier, and the more your multiples likely to be, etc. I think in terms of retaining key personnel, what approaches have you seen? I've seen them all, I think, from people gone on day one to people being tied in for a period of time. I think the real answer to that question, Stuart, is if if the person is integral to the value of the business, i.e., you know, if I'm a buyer and I'm looking at that business and I'm going, that individual there is absolutely key to what I'm buying, then you as the seller need to somehow lock them in. Now, that doesn't need to be shares. You know, it can be, but really you probably need to involve them in the sales process somehow, and you need to incentivize them through bonuses or whatever you choose to do, because, you know, if they walk, then some of your value of your business walks. So you've got to somehow keep them locked in. I think we've talked about business brokers, and we've talked at, well, enterprise management incentives. That's a tax thing, I presume, is it, Mike? EMIs?
Yes, the share options, which have they're heavily tax incentivized, and a great way to lock people in. So one of the businesses that we sold last year, we'd started working with the owner, in fact, on a plan for the management team. So we put in place exit only EMI options. So those were done 3 or 4 years ago, and it's a cashless exercise. So when you get to completion date with a buyer, the EMIs are exercised, profit goes out the door to the management team, profit from the share sale.
Okay. Yeah.
And actually, it's really great because the difference in value between the exercise price and the underlying value of the shares can be quite substantial, and that weirdly gets charged to the profit and loss account of the company. So it actually then created a bounce for the for selling out.
Yes, and that then forms part of, it does become part of the equity value to enterprise value bridge. Is it if that tax saving is sufficiently high, then you can then try and negotiate that as part of the equity value for the seller, if you feel particularly confident.
Okay, cool.
The other, I think there's the question just popped up there, is the good thing about share options of any description is in this is it obviously incentivizes the management team that there is a future capital gain that they could be, as long as they're there with the business, and that is the advantage is as long as they're there with the business, because the options where with a properly drafted scheme, as soon as somebody leaves the business, those options just lapse, so it never costs you anything other than the original fees for drafting, and then it can be redistributed in due course to somebody else, or it gives everybody else, you know, the existing shareholders, a little bit of an equity lift based on what they thought they were going to get. So there's that, and actually the other part of options is nobody is part of then of any shareholder groups, so it has no rights around shares, which makes things a lot easier as a business owner.
Yeah. There's a question about what's an earnout, please. So do you one of you guys want to define that, or shall I do it in my simple language?
I think we covered that as we went, but just shout if we didn't.
Yeah, I think what I would say is just an earnout is it's subject to the performance of the business going forward, as opposed to deferred payment where you've agreed the amount up front and it's just not coming to you, you know, until a future date. And obviously, as Mike said, the problem with the earnout is the new purchaser, the new controller of the business can affect the profits in a way that you can't control. Susan's asked, what's the optimal structure of an earnout for the seller? There isn't one. You don't have an earnout at all. You get 100% cash up front. Is there a better answer to that question, gentlemen? I don't know.
No, no, not really.
They're probably the most problematic things after completion of a deal, Phil, is working out the earnout. So never mind all the warranties and warranty limitations and everything. It's working out how much is due and what the triggers were for the earnout.
I think the perversity is the best insurance policy against an earnout is staying with the business in a management position, so you can control as much as you can control. Which, if you were looking to de-risk, change your lifestyle, is completely counterintuitive. But unfortunately, that is a factor of an earnout. Yeah,
and I mean, Mike and I have been involved in one recently, and the founder has exited, and the two kind of key employees have changed, but ultimately the earnout element is completely up. It's just a gamble, really, as to whether you're going to get the money. There's an EMI question there. Did you just answer that one, Neil? Using an EMI share scheme conditions, can the employee? Yeah, I think you've answered that, haven't you? So I guess opening it to the floor, are there any other questions that people would like to get answered while you've got Mike and Neil on? All quiet on the Western Front. Anything we've missed, gentlemen, that you think we should have covered?
I think that's been quite a full discussion, Phil. So thanks for.
Oh, so we've got creative finance for buying a business. You're
the master of that one, Phil, I think.
Yeah. Look, I mean, the reality is you're trying to use as little of your own cash as you can when you're buying a business. So you're looking at the assets in the business to see if they're unencumbered or not. You're looking at the working capital. Obviously, in B2B situations, you can use invoice financing. And really, in terms of buying a business, which goes a little bit against what we're talking about here, the best way is to get the seller to fund it for you. And certainly my first involvement with Mike came from a guy in the Central Belt who had his business listed with a broker for 2 or 3 years and got absolutely nowhere close to the price that he wanted. And then, a friend of mine was just interested in that business. And in the end, the seller got the price he wanted by effectively funding the guy I knew over a 5-year deal. And, ultimately there's some risk to that, but it meant the seller was almost in control for the 5 years of the funding. And yeah, it worked for both sides. So there's lots and lots of ways to skin the cat. And obviously we've been looking at this from the sales side, but there's a lot of debate on both sides. And I think ultimately Neal's original point of give yourself a bit of time to plan this and give yourself a bit of time to get ready for this and get some advice that ensures, what is often a one-off event for people, you do it as well as you can. I think that's probably hopefully the best way to sum it up. Last question. If I was a seller and then I was willing to sell a finance, I'd then put a floating charge on the business to cover myself. Mike, you're the expert here. What do you call those things? Loan?
Yeah. So having some form of security, Tam, is absolutely right. That's what you'd want to look at. So that's all right if it's a third-party sale. If you end up doing some sort of management buyout, VIMBO process, or an employee buyout, it's actually really difficult to get security because it cuts across your tax clearance. But yeah, on a third-party sale, absolutely, it works really well.
Okay, cool. All right, no problem. I think that is us almost on time at 1:30. Hope everyone enjoyed that. Mike, Neal, thanks ever so much. Really informative. You guys are proper experts in this field, so hopefully anyone that needs some help can reach out to you guys. Yeah. And how do they get hold of you? Have your details been shared anywhere, or?
We can do that afterwards if that would be appropriate. If you guys are happy for us to do so, we can share that with all attendees.
Well, if they need an expert, I'd recommend these two. They've got me out of a lot of trouble. Thanks ever so much.
Good. Thanks, everyone. Thank you.
No, thank you. Cheers, guys.
Thanks. Bye.
Bye-bye.